Hello friends, our economy fell and you know this now for more than 2 weeks. We have seen all those memes on internet. Amongst Kangna Ranaut and Riya Chakrabarti gaining all our media's attention, I went on to research on how we can improve the falling numbers. And the answer is, no, not this. This is how I got my answers to the crashing economy, though and she got behind bars. Seriously girl, you don't need lawyers, you need him. Okay, without taking much of your time in next few minutes, I will provide you the context and some plausible solutions that are very much practical to implement. Welcome to the Unexplained. Let us come over to the context. Our nation's economy is a result of various sectors working as a well-oiled machinery towards the nation's growth. These sectors include manufacturing, power, retail, agriculture, hospitality, amongst many others. They all work in conjunction, and a nation can then boast of a strong and stable economy. Once this happens, people show their trust in the financial systems and make investments which further drive the above-mentioned cycle. The scale of investment may vary, right from the angel investors supporting upcoming and established businesses to an individual showing confidence in the stock market. Things work fine until any of the above-mentioned sector disrupts. This brings in the domino effect and slowly the disruption, if not fixed in time, is seen over other sectors, bringing economic slowdowns, recession, and if prolonged, then terminating in acute economic depression. COVID-19 has been one such trigger that has brought countries in a volatile financial state and has shaken the global as well as individuals' manner of investing. Coming over to India and its various financial quarters. Let's discuss the pre-COVID financial quarter. In the fourth quarter of the financial year 1920, Indian economy witnessed an economic slowdown where the GDP came down to 3.1%. The fiscal deficit, as estimated by the Ministry of Finance, was at 3.8% just before 60 days of closure of the financial year. This fiscal deficit at the end of the financial year was reported to be 4.6%. And the Ministry of Finance failed to comprehend that. Had the comprehension been made well in time, some measures depending upon the effect on various sectors would have helped in restoring the confidence of the investors. Coming over to COVID-19 and effect of lockdown. With government announcing nationwide lockdown, demand fell drastically. Since private demand constitutes of major chunk of GDP, latter started to follow the downward slope. Falling demand shook the confidence of private investors in the market. As a result, they started to withdraw their investments. Private investments are the next big contributor towards the GDP calculation after private demand. With investments falling, GDP contraction continued. This was pertaining to the organized sector, which contributes formally towards GDP calculation. The informal sector and the small manufacturers, that is SMEs, were worst hit. Faced cash flow issues due to the weakening of demand, as majority are tier 2 and tier 3 suppliers in the chain of manufacturing. That is, the finished products serve as raw materials, components, subsystems to large manufacturers such as automobile industry. Let us talk about mitigation measures and boosting the demand. Now, demand creation. The only way to attract investments is by gaining confidence of the buyer. Once the buyer has faith in market, the cycle of supply and demand restores. As a result, the government needs to look at creating demand. Out of 20 lakh crore revival package announced by the government, only 1.2 lakh crore has been assigned for demand creation. The government is reluctant to do more today. It can be assumed that it is reserving its actions for demand creation in future when the market starts to show some upward trend post complete unlock from the lockdown. This strategy may be self-defeating. Talking about stimulus packages, our finance ministry has been looking at revival of various sectors and big relief packages have been announced in that regard. We need to look west in our approach of providing economic relief measures. Economies such as the US and Italy, which were worst hit by the pandemic, have been able to manage their GDP contraction better than us. This has happened because of rounds of the stimulus packages. Insurance to the unemployed and direct transfer into the bank accounts are few measures adopted by the US government. India has a large chunk of its population working in the informal sector, and it is this sect of people who have lost this means of livelihood. India needs to directly empower these buyers despite the fall in income. Once the people have ability to spend, the cycle of credit will flow and the revival will begin. This can happen by providing direct bank transfers to the common people so that their spending capability is increased. Once the private spending will increase, GDP will also rise. Talking about relief to manufacturers, the GST collection. Confidence building measures are the need of hour. There have been constant modifications in the GST. Various income tax reforms have also been introduced in past 1 year. These measures, though, aim at eradicating loopholes in tax collection mechanism. Manufacturers have to constantly focus on compliance to the updated reforms. As a result, the manufacturing suffers, especially for small manufacturers with limited staff. This also hampers the investment as large investors are not very comfortable with a government which is not capable of rolling out sound reforms at once. In order to attract investment, a direct GST rebate of 7% can be provided to the manufacturer directly into their bank account for 1 financial year. This will boost their production capabilities and will also attract investors who will be willing to invest in a financially decluttered environment. This will have a twofold advantage. One has been listed above, and the second will be the adjustment of balance of GST to be paid by the center to the state governments. Not only will the cycle of production will be supported, the center-state ties at accepting the GST as a positive reform will also strengthen. Talking about pending infrastructure projects. Infrastructure projects have always been a mechanism of job creation. They also attract hefty investments in our country. But the rollout of such projects in many cases is done without proper site considerations. For example, the Chennai Expressway to connect the Chennai port to the outskirts of the city could not be completed over a decade just because the final site at the Chennai port was not finalized. As a result, the Indian Navy had to clear off some space and the project could be taken to competition. There are plenty such examples where complacency in proper planning has affected the timelines. This hampers the interest of investors into a project. The infrastructure projects have a vast potential of providing employment to the people in informal sector. The projects in pipeline must be issued to contractors in a fast-track manner with due diligence to the land and labor laws. Talking about investments in safe havens. The pandemic has once again revived the notion of gold being the safe haven for investors. With markets falling, people and governments were running toward the yellow metal, and the price of the yellow metal reached to an all-time high of $2,000 an ounce in the commodities market. This shows the faith of the investors in the market. India has also imported large amount of gold during lockdown. With lockdown coming to an end, industries have picked up and so have markets, and this is a positive sign. Even the small investors are now moving towards investing in stock and the commodity market. Coming over to new avenues of investment. The pandemic has changed how certain industries function. The education, agriculture and pharma sector are amongst few which have flourished even under pandemic. These have been able to draw heavy investments. Within India, being leader in production of generic medicines and the research on the production of COVID-19 vaccine being in competition with the firms globally, pharma has shown promise of stability and have been able to attract the small and large investors even in the time of pandemic. Similarly, the scope of shifting the education onto the digital platform has opened plenty of opportunities in terms of infrastructure development to promote e-learning and hence have capability to attract heavy investments into the Indian markets. Let us talk about the conclusion. Our economy is in bad shape. We speculate V-shaped recovery, but we have a long way to achieve it. Temporary half-baked reforms will do a little to amuse the industry and the workers. Jumping to conclusions at this point in time would be immature, just like calling the momentary spike in the demand in automobile industry as a testimony of V-shaped recovery. Proactive stimulus measures have to be taken for confidence building of both the consumer for demand creation and the manufacturers to boost their supply. What do you think of the same? Let us know in the comments. And for more such content, stay hooked up to the unexplained. See you until next time.